Picture this. The screens are glowing green, headlines are screaming record highs, and yet, beneath the noise, something feels wrong, very wrong. Because while the crowd is celebrating, the smartest money in the world is quietly moving the other way, not chasing returns, not taking risks, but bracing for impact. There is one trade dominating global markets right now, a trade so crowded, so quietly defensive that it doesn't look dangerous at first glance. It looks safe, it looks smart, it looks responsible. And that's exactly why it should stop you in your tracks. Because when fear disguises itself as wisdom, when protection becomes more popular than progress, and when everyone believes they've found the same safe exit, history tells us we're standing at the edge of a moment that changes everything. Tonight, we're not talking about a crash. We're talking about the signal that comes before it. When investors rush towards so-called safe havens, it's easy to mistake that movement for wisdom. It feels disciplined, it feels cautious, it feels responsible. But markets have a habit of disguising fear as prudence, and right now, that disguise is wearing a very familiar color: gold. Let's be clear about what's happening. Gold prices pushing to record highs are not a celebration of stability. They are a signal flare. They tell us that a growing share of global capital is no longer looking for growth, innovation, or productivity. It is looking for shelter. And when capital prioritizes shelter over opportunity, that should give every serious market participant pause. Historically, gold performs best not when economies are strong, but when confidence is weak. It thrives in environments where investors doubt monetary discipline, question fiscal responsibility, or fear that inflation will quietly erode purchasing power. So when gold becomes the trade everyone agrees on, it's not because the outlook is bright, it's because uncertainty has become consensus. What worries me is not the metal itself. Gold has always had a role as a hedge. What worries me is the scale and speed of the move. When flows accelerate into a defensive asset this quickly, it tells you that investors are reacting emotionally, not analytically. They're not asking what creates long-term value. They're asking what won't hurt me tomorrow morning. That shift matters. Markets function best when capital is allocated toward productive risk, toward businesses that build, hire, innovate, and grow. When that capital instead crowds into a static store of value, it reflects a breakdown in trust. Trust in central banks to manage inflation. Trust in governments to control debt. Trust in the durability of the financial system itself. And here's the uncomfortable truth. Crowded safe haven trades are not safe. When everyone is on the same side of the boat, stability becomes fragile. Liquidity dries up. Small changes in sentiment can trigger outsized moves. The very asset investors run to for protection can become volatile precisely because it is so heavily owned. There's also a deeper message embedded in this trade. Choosing gold over productive assets suggests a belief that the future will be defined more by preservation than progress. That is not how strong economies think. That is how nervous economies behave. Markets are forward-looking mechanisms. They don't just price earnings and interest rates, they price confidence. And right now, the enthusiasm for gold is priced in doubt. Doubt about policy discipline, doubt about long-term growth, doubt about whether traditional anchors of stability will hold under pressure. That's why this trade concerns me. Not because gold is rising, but because fear is rising with it. And when fear becomes the dominant investment thesis, markets stop rewarding intelligence and start rewarding reflex. That is never a healthy place to be. What we're witnessing right now is not just a tactical reallocation of portfolios, it's a philosophical shift in how investors define safety. Capital is quietly but deliberately moving away from the US dollar and into what I would call deviation assets: gold, digital currencies, and alternative stores of value that exist outside the traditional monetary framework. That movement should not be taken lightly. For decades, the dollar has been the unquestioned foundation of the global financial system. It has represented liquidity, reliability, and the rule of law. When uncertainty struck, investors didn't ask where to hide. They already knew. So when capital begins to explore alternatives, it's not because those alternatives suddenly became perfect. It's because confidence in the anchor is being tested. This shift is being driven by a growing anxiety about long-term fiscal discipline, persistent deficits, Expanding debt and political gridlock create an environment where investors begin to ask uncomfortable questions, not dramatic questions about collapse, but subtle ones about erosion, about whether purchasing power will quietly weaken, about whether monetary policy will remain a stabilizing force or become a reactive one. Gold and digital assets benefit from that uncertainty because they sit outside the system. They are not liabilities of a government. They are not directly tied to central bank balance sheets. And in moments of doubt, independence becomes attractive. But attraction does not equal stability. The danger here is narrative-driven investing. When the story becomes the dollar is risky, investors start extrapolating fear far beyond the data. They stop measuring probabilities and start trading headlines. That's how markets drift away from fundamentals and toward emotion. Digital assets in particular reflect this psychology. They are volatile, sentiment-driven, and still lack the institutional depth of traditional currencies. Yet they are being embraced not because they are proven, but because they are different. That should tell you something about the mindset shaping today's markets. I worry when investors choose alternatives not out of conviction, but out of distrust. Distrust of policy consistency, distrust of inflation control, distrust of long-term governance. Because distrust is contagious. Once it spreads, it doesn't stay neatly contained within asset classes. It bleeds into equity markets, credit markets, and eventually into real economic behavior. Capital flight from the dollar doesn't need to be dramatic to be meaningful. Even marginal shifts signal a reassessment of risk at the highest levels of global finance. And reassessment, when driven by fear rather than evidence, can distort prices and expectations in dangerous ways. Strong systems rely on confidence, not blind confidence, informed confidence. When investors begin seeking safety and deviation rather than structure, it suggests that confidence is no longer anchored, but drifting. That's the real concern. Not that alternatives exist, they always have, but they're being treated as refugees rather than diversification. When the world's most trusted financial instrument starts being viewed as something to hedge against, rather than rely on, markets enter a far more fragile phase, and fragility, once embedded, is difficult to unwind. When investors begin to lose faith in traditional stores of value, the consequences extend far beyond any single asset class. This isn't just about what people are buying, it's about what they're questioning. And right now, what's being questioned is the reliability of the financial architecture that has supported global growth for decades. Traditional stores of value work because they are underpinned by trust. Trust in institutions, trust in policy frameworks, trust that inflation will be managed, debts will be serviced, and markets will remain orderly even under stress. When that trust weakens, investors don't immediately abandon the system. They hedge against it. And hedging against the system is precisely what we're seeing today. The concern is subtle but profound. Investors are signaling that they no longer believe conventional instruments alone can protect purchasing power over time. They're not rejecting the system outright. They're quietly insuring themselves against its potential failure. That shift in mindset is what should demand our attention. Markets are remarkably efficient at absorbing information, but they are also deeply sensitive to belief. Once belief starts to erode, even incrementally, behavior changes. Investors shorten their time horizons, risk appetite contracts, capital becomes defensive. And when capital turns defensive, growth lows, not because opportunity disappears, but because confidence does. There's a misconception that diversification into alternative assets automatically represents sophistication. Sometimes it does. But when diversification is driven by fear rather than strategy, it becomes a warning sign. Investors begin to prioritize insulation over productivity, preservation over progress. That trade-off may feel rational in the short term, but over time it weakens the very engine that creates wealth. What's particularly troubling is how quickly skepticism can cascade. When influential institutions adjust their positioning, others follow. Not because they've independently reached the same conclusion, but because they don't want to be the last ones exposed. That's how risk perception becomes amplified and how markets drift away from fundamentals. This dynamic creates a feedback loop. Fear drives defensive positioning. Defensive positioning dampens growth expectations. Lower growth expectations validate the original fear, and before long, markets are reacting to their own anxiety rather than objective conditions. The erosion of faith in traditional stores of value also complicates policy responses. Central banks and governments rely on credibility as much as tools. When credibility weakens, every intervention must work harder to achieve the same result. Signals become less effective, guidance becomes less trusted, volatility increases. None of this suggests imminent collapse. Markets are resilient, and systems adapt. But resilience depends on confidence being restored before skepticism hardens into conviction. Once investors collectively decide that traditional anchors can't be relied upon, reversing that belief becomes extraordinarily difficult. That's why this moment matters. It's not defined by panic, but by hesitation, not by crisis, but by doubt. And in markets, doubt is often the most dangerous stage because it quietly reshapes behavior long before prices fully reflect it. When faith in established stores of value begins to crack, even slightly, it tells us that the problem isn't a single asset or policy. It's the underlying trust that holds the entire system together. And protecting that trust should be the highest priority of anyone who cares about the long-term health of global markets. Markets have a long memory, and they have an even longer habit of repeating human behavior under pressure. When I look at what's unfolding today, I don't see anything unprecedented. I see familiar patterns resurfacing. The details change, the assets change, the technology changes, but the psychology remains remarkably consistent. Periods of market stress are often preceded by a collective shift from analysis to instinct. Investors stop asking what something is worth and start asking how quickly they can get into or out of it. Safe haven trades begin to dominate conversations, not because they've suddenly become more attractive, but because they are emotional comfort. And history tells us that when comfort becomes the primary investment rationale, risk is usually underestimated, not avoided. We've seen this before. Crowded trades form when fear converges around a single idea. Everyone agrees on the same narrative, reinforces it, and assumes that consensus equals safety. But consensus is rarely where protection lives. It's often where fragility hides. When too much capital floods into the same defensive positions, markets lose balance. Liquidity becomes one-sided. Price discovery weakens. Small shifts in expectations, a data release, a policy comment, a geopolitical headline, can produce outsized reactions. What looked stable under normal conditions becomes unstable under stress. The danger isn't the initial move into safety. That's understandable. The danger is when the trade becomes self-justifying. Rising prices reinforce the belief that the move was correct, attracting even more capital, further crowding the position. At that point, the asset is no longer a hedge. It's a momentum trade wrapped in the language of caution. History is unforgiving of these setups. When sentiment eventually turns, exits become narrow. Investors discover that what felt liquid on the way in is far less liquid on the way out. Losses don't come from fundamental deterioration alone. They come from the sudden realization that everyone else is trying to leave at the same time. What concerns me most is how quickly experience gets eaten by recency. Markets convince themselves that this time is different, that technology, data, or policy frameworks have somehow neutralized old risks. They haven't. Human behavior hasn't evolved at the same pace as financial instruments. Experienced investors learn to be most skeptical when a trade feels obvious. When protection appears easy, when narratives align too neatly, dissent disappears. That's when risk becomes mispriced. Not because information is lacking, but because judgment is suspended. Crowded safe haven trades don't signal stability, they signal vulnerability. They tell you that fear has become synchronized, and synchronized fear is inherently unstable. The system becomes sensitive to surprises, even small ones. Markets don't unravel because everyone is wrong. They unravel because everyone believes the same thing at the same time. And right now, the alignment of fear into a narrow set of safe ideas should make thoughtful investors uncomfortable. The lesson from history is simple but difficult to act on. Safety is rarely found where everyone is looking. And when markets start to feel eerily familiar, it's usually because the same mistakes are quietly being made again, just under new names and new charts. The most significant risks in markets are rarely the ones being openly debated. They're the ones that quietly reshape behavior while everyone is focused on surface level explanations. Right now, the real risk isn't any single asset class or trade. It's the gradual breakdown of risk tolerance itself. When investors lose their willingness to engage with uncertainty, markets begin to change character. Decision-making becomes defensive. Time horizons shrink. The priority shifts from building long-term value to avoiding near-term discomfort. That shift doesn't announce itself with volatility spikes or dramatic headlines. It shows up in positioning, in capital flows, and in the types of trades that gain popularity. A market driven by fear doesn't reward insight, it rewards reflex. Investors stop differentiating between good risk and bad risk. Everything starts to look dangerous, so the response is to retreat into whatever feels most insulated. But insulation is not the same as resilience. Resilient markets depend on participants who are willing to absorb uncertainty in exchange for future returns. When that willingness fades, liquidity becomes conditional. It exists only as long as sentiment holds. The moment confidence wavers, liquidity disappears and prices adjust abruptly. That's when moves become disorderly. Not because fundamentals have suddenly changed, but because participation has. What concerns me is how easily fear can become normalized. Once investors accept caution as the default posture, they stop questioning it. Defensive positioning becomes habitual. Over time, that habit suppresses innovation, capital formation, and growth. Markets don't collapse, they stagnate, and stagnation is often more damaging than volatility. This environment also distorts incentives. When preservation is rewarded more than productivity, capital flows away from areas that drive economic progress. Risk-taking, the kind that builds companies, infrastructure, and technology, becomes scarce. That doesn't just affect markets, it affects real economies and real livelihoods. There's also a misconception that extreme caution is a form of discipline. Discipline requires judgment. It requires evaluating risk, not avoiding it altogether. When fear dictates decisions, discipline erodes. Investors stop asking whether a risk is worth taking and start asking how to eliminate risk, a goal that is neither realistic nor healthy. Markets need belief in the future to function properly. Not blind optimism, but a reasoned confidence that progress is possible. When that belief weakens, markets lose their forward-looking nature. Prices begin to reflect anxiety, rather than expectation. The irony is that excessive fear often creates the very instability investors are trying to avoid. By withdrawing risk tolerance from the system, they make it more fragile. Fewer participants are willing to step in during stress. Fewer are willing to provide liquidity. Shocks become amplified. That's why the most worrying signal today isn't volatility, inflation, or any single trade. It's the quiet retreat from risk happening beneath the surface. When markets stop believing that the future can be managed and start acting as if it must be feared, rational pricing breaks down. The challenge ahead isn't restoring enthusiasm, it's restoring confidence in thoughtful risk-taking. Because markets don't function on certainty, they function on courage informed by analysis. And when that balance is lost, even the strongest systems become vulnerable. So remember this, markets don't collapse when the numbers finally break. They collapse when belief quietly disappears. When confidence slips out the back door while everyone is still applauding the headlines, and by the time fear becomes obvious, it's already too late to outrun it. The most dangerous moments in finance are never loud. They are calm, comfortable, convincing, and when the world's smartest capital stops asking how much it can make and starts asking how much it can protect, that isn't the end of a story, that's the warning shot. Because the next move won't be announced, it won't be televised, and it won't wait for consensus. The only question left is this: will you recognize it before the market does?